Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, I am super happy to be here today for two reasons. One, I've got a brand new mic that I'm trying out today. So I feel like a professional podcaster right now. And so hopefully everyone can hear my voice very clearly. But more importantly, I've got a fantastic guest for everyone today. She's going to give us the download on areas of law that are, in my opinion, a lot of times when I talk to clients about these various areas, there's a lot of mysticism and a lot of things that they build into, they build a lot of components in their head about it. And I'm not sure they completely understand all the ins and outs to it. And my guest today is one of the few people that I've met that's truly a specialist in these particular areas and that has dedicated, a good part of her career to being able to provide great advice. And I've seen her in action. So without further ado, Elizabeth McMorrow, welcome to the podcast.
Hi, Mishkin. How are you doing? Thanks for having me on. Looking forward to our chat.
Absolutely. So today we're going to talk about all things related to information exchange in the world of FATCA, CRS, CARF. You may not know what those acronyms stand for. And for tax podcasts, where those are generally chock full of acronyms, but we're going to do our best to kind of give you the inside baseball about what those acronyms mean and how they could apply to you. But before we get into all that good stuff, let me just get some general background from Elizabeth, because we actually went to BU Law together to get our LL.M. So I got a former classmate here, and I was thinking, this morning I went to the gym and I was thinking in my head, like, which BU law professors would I love to have on the podcast? I can only think of one. So Elizabeth, I'm going to ask you the same question at some point in time. But right now, why don't you start by giving our audience a little background into your education, your licenses, your practice areas. Tell us a little bit about your firm. Just give us your 30-second elevator speech.
Sure. My background has been varied, at least for attorney purposes. I've kind of had three stages to my career. I have my early stage, which was international trade litigation. And so that was 2 years at the U.S. Court of International Trade, clerking for a wonderful federal judge, followed by working with a large New York law firm's DC office. And so we did anti-dumping, countervailing duty, Section 301. It was just a really great experience, and with a really interesting multidisciplinary team, which I really enjoy working not just with lawyers. And so after that, I moved on to what I thought was my primary goal for my career, which was in-house doing what we used to call international legal operations. But I think sometimes now people think of that as more computer services for inside the corporation. It's taken on a different sort of definition. So what it meant then was being a point person for people who are outside of the U.S. headquarters. And so I was at the Coca-Cola company and also at a biotech company. And so, for example, at the biotech company, all the general managers around the world would deal with me on day-to-day issues that we would figure out. Is that even something to deal with? Is it such low risk? Is it something I can handle? Is it something I need outside counsel in your country to help us with? And so it was just being the small town lawyer around the world for my business colleagues. And that was a lot of fun. And of course, prior to that at the Coca-Cola company, who could not have fun with the issues that come up there, and such knowledgeable people who are, today people put on their resume that they've been someplace 6 months or 18 months. And at Coca-Cola, people stay 20 and 30 years. And so you just learn so much from them. After my in-house international business stage of my career, I took off a little time, did some pro bono for low income clients, teaching refugees vocational English, exploring non-lawyer, in-house work. And then, as did you, got the BU degree, LL.M in taxation, and ended up in the FATCA world. When we came out of our LL.Ms, FATCA was just percolating, and
Yep.
so I fell into that with a startup company. And after a few years there, decided to just take the plunge and start my own practice.
Wow. And you really did come out at the perfect time to, become an expert in FATCA. It all basically just was laid out at your feet right when we graduated, going into those early years. And it was a super interesting time. I remember clients, because I was working a lot in Switzerland at that time and doing a lot of offshore voluntary disclosure. And we had a lot of clients that would come to us and say, hey, this is what the bank is telling us they're going to disclose under FATCA. Let's look at it, and let's look at, say, the Form 8938, and we want to make sure it all matches. And we would spend hours, and all these fees would be charged on it. And I look back wistfully on those days. I'm like, people don't give that much attention to that form anymore as much as they used to. We had to make sure every little box was ticked and everything was tied out. And it was an unbelievable amount of work that went into it at that point in time.
Yeah, it was, I think it was it was a heck of a lot of work for the financial institutions and their service providers, having this learning curve. And the IRS was learning at the same time, because
Right.
they were changing the rules as people were trying to comply, not to be obstructionist, but figuring it out on the go, and also realizing that maybe some aspects of it are just too burdensome for the value add. And so it was definitely an interesting few years.
Yeah. Okay. So let's reset for a second. Let's talk to our audience as if they were a 3-year-old or a 5-year-old, however you want to, look at that. But can you just briefly describe to us FATCA, and then maybe just quickly go into CRS and CARF, just
Sure.
so that we're doing some table setting for the audience?
Sure. Just to get a general understanding, as Mishkin says in the overall lead into his podcast, all the acronyms, we're not going to break down FATCA acronym because nobody ever uses it. It's just FATCA. CRS, Common Reporting Standard. And then CARF, CARF, is the new kid in town, and that's the crypto asset reporting framework. Now, the major difference between the three is that FATCA is entirely a U.S. made and enforced, well, I shouldn't say and enforced, a U.S. made law, and it's for the U.S. benefit. And so the U.S. government said, we want to track people around the world who are U.S. persons, so U.S. citizen, U.S. green card holder, U.S. tax resident, who are not telling us that they have these accounts abroad. We feel that there is tax that we're missing out on. The rest of the world said, once again, the U.S. is imposing its will and burdening the rest of us with what they want. And what are we getting out of it? Nothing. And the reason they're saying this as a burden is because prior to FATCA, we had that the U.S. person would have to, as an individual, report what was going on abroad within certain parameters. We won't get into it just now. And so there was already this requirement between the U.S. person and the U.S. government. But then with FATCA, the U.S. government said, we don't trust all those U.S. persons. So we're going to make the financial institutions around the world spend all this money on compliance and reporting and track down these bad U.S. persons. And so this is why the foreign governments, so when I say foreign, I should say non-U.S. governments, were upset because here's this foreign government demanding confidential information from its financial institutions. But what happened was that the foreign non-US governments said, oh, wait a second, maybe we could do something like this. And so you had the OECD, the Organization of Economic Cooperation and Development, come up with a model. And this model was then adapted into local legislation by a large number, over 100 jurisdictions around the world, because the non-US government said, well, we could do with our residents, tax residents, what the US government is doing. We can find out who's not paying us taxes. And so they used this OECD model to come up with something that was similar to FATCA. And even though the US is part of the OECD, the US said, yeah, we're good. We've got FATCA up and running. You guys go ahead and do what you like with CRS, the Common Reporting Standard, but we're going to stick with FATCA. And so that meant that financial institutions had to follow two different systems. There is great overlap, but there's enough difference that it does increase the financial burden to those who have to comply. And then just to take the big picture one step further, for all these years, because we've had FATCA came in for the due diligence in 2014 and the actual reporting in 2015. And then CRS was just a little bit behind. And so by 2016, we're up and running with CRS. All during this time frame, we had the idea of crypto assets coming up and percolating and getting bigger and bigger. And yet it was none of these assets were considered financial asset within the definition of financial asset with FATCA and with CRS. And as it became such a huge part of the financial world, governments realized, obviously, saw it with what's been happening here in the U.S. last year and this year with having greater regulation and legislation around crypto assets. We're trying to capture those now, and that's where the OECD came up with a new model called, we just have the acronym CARF, kind of unpleasant word. And so CARF is trying to fill that gap where CRS and FATCA did not. But the hitch here, once again, with the US always doing its own thing, is that the US had said that they would be part of the jurisdictions that would start up CARF as of January 1, 2026. At least with the due diligence would start, and then the reporting in 2027. But the US pushed back and said, we're going to delay. Even though we said we'd start 2026, we're going to go ahead and target 2028 with CARF reporting 2029.
Okay.
But we don't know if that date will stick. We don't know whether the process will be folded into FATCA or whether it'll be much more aligned with the OECD CARF. So stay tuned on that.
Yeah, no, I mean, you've got a lot of people clamoring that there should be digital asset, cryptocurrency tax legislation in the next tax bill. You've got people clamoring for updates to all the U.S. tax treaties to include digital assets. Do you think that maybe as part of this, potential updates to the treaties / legislation, that CARF will probably get rolled into that as well too? Do you see that would be an add-on that they would probably put in there, or do you think it's just a standalone?
Yeah, I prior to President Trump becoming very keen on the crypto industry, I would have questioned whether he would go down the path of CARF, because FATCA itself is not something that would be ideal Trump legislation. FATCA came up during President Obama's administration, and with President Trump, he's not keen on burdening industry with too much regulation. And so FATCA would fit into that category. And so you do have that tension between FATCA not being something he would be keen on, and his interest in the making sure that crypto assets are being pulled into the, what we call TradFi, traditional financial world, that it should be just factored in. So I do, prior to his interest, I would say, would he go through with CARF? But now with that interest, I can see that there might be the interest in trying to complete the framework. We're getting a very good framework just within the US as far as US tax reporting by crypto asset holders. And so I think that could be something they move forward on. I guess I'm surprised they pushed it out 2 years rather than just 1 year. So it gives me pause as to what commitment this administration will have to it.
Yeah,
but it is better than, I'm not one to go out and tout any particular asset, including crypto. But I think that what we experienced during the President Biden's administration was very difficult for the crypto asset folks, because either say it's legal or say it's illegal. Say what the parameters are, create the world. If it's not going to be illegal, create the world in which people can feel that they are compliant and aren't going to be caught out.
Yeah, and it's interesting because the White House has their digital asset report. I think that came out in July. You've got the Coinbase vice president that testified before Congress. I think that was October. You've got the Digital Asset Parity Act, I think that was introduced at the end of the calendar year. So there's a lot of movement in this space, and certainly, we'll have to keep an eyeball on how CARF gets folded into that. I'm going to come back to CARF in the digital asset space, but for right now, the next question I'm super curious about.
Right.
What is the current we're here in 2026. FATCA has been, as you said, kind of came into being in 2010, really kind of fully implemented, I think you said 2014. Where are we at today? We're here on February 11th, 2026. What is the current impact with FATCA? Let's talk about individuals first. So let's just talk about U.S. expats or U.S. taxpayers, generally speaking, that have specified foreign financial assets. What's the current impact on them? What are some common issues that you're seeing or looking at? And then I'd love to get your last comment would be, I don't know if you saw the National Taxpayer Advocate. I'm sure they've called for this before, but the elimination of duplicative reporting between the FBAR and the 8938. What are your thoughts on that?
Sure. I'll put a big caveat here that my practice is that I represent financial institutions, not individuals. However, I definitely have opinions on things, whether I'm representing individuals or not. And so, I do agree as far as, the 8938 and the FBAR. And for those who are new to this game, the FBAR has existed for decades. And that was the form by which a U.S. person would have to report certain assets that they had overseas. And so then when FATCA came in, they not only I have a problem with FATCA. I'm not a big FATCA fan as far as from a conceptual standpoint. One thing I think is, this total mistrust of U.S. persons, because we did have the FBAR. The second thing is that when FATCA was being considered and debated, we had at that time in 2008, 2009, subcommittees in Congress, both on the House and Senate side, giving astronomical projections of what the lost revenue was. And so we had in 2008, one estimate being, $100 billion. And then we had in 2009, $150 billion per year being lost. And then about a month before the bill was passed, so we've had a couple of years of people hearing these big numbers, and then only 4 weeks before there's this complete change in projection. In fact, let me just get it here. I've got the number that we slashed it down from 150 billion a year to 870 million per year. And so the whole premise was, faulty. And it's unclear, when people were voting, what number they had in their head. So now we move on, we pass FATCA, and we put another burden on with the Form 8938, where individuals have to file this form, and it's certain amount of data is the same as the FBAR they might have to file. But then the the 8938 is a little bit more inclusive of additional data. And the thing that gets me frustrated is with both the FBAR and the 8938, when the US government comes after you for failing to file or failing to be totally transparent with everything that belongs on those forms, the penalties are tremendous. And so, for example, if you have a couple that retires to, say, Costa Rica, and they set up a bank account in Costa Rica, and they give all of those banking details to the US government so that their Social Security checks can be deposited. And then, because they're unaware that all these forms have to be filed, they fail to report their Costa Rican bank account. Well, in their mind, how can you penalize me and take all this money when you, the US government, know I have this bank account? You're depositing my Social Security check. And so I find the size of the penalties ridiculous. And I definitely would say, if you're going to demand a form, then consolidate what you want into one form to reduce the burden. And when I see some back and forth on this, whether it should be consolidated or not, it's another bizarre thing for me, is that you have people, because for the folks who are unaware, the 8938 goes to the IRS and the FBAR goes to FinCEN. Both of these organizations are housed within the US Department of Treasury. So if you're thinking of it as a corporation, they're two different parts of the one corporation that both roll up to the same CFO and the same COO and the same CEO. And yet you'll have people from IRS say, well, what if FinCEN removes this? And if we say, oh, we're not going to ask for item A on our form, but then FinCEN no longer asks for item A. You're the same corporation. Talk to one another. Come up with one form that you both can share. So I do get a little frustrated with US government not talking to one another. And I think we've seen a lot of that with some of the large auditing that's been going on.
Yeah, and just for the folks at home to understand what she's talking about with penalties, the FBAR penalty, civil non-willful penalty, is $10,000, adjusted for inflation after January 17th, 2025. Any penalties you would receive on that is $16,536. And then the 8938 is a weird kind of penalty structure. So what happens is it's a $10,000 initial penalty. Then they send you a notice saying, give us the form or give us a corrected form. And then for every month you fail to do that, it's an additional $10,000 penalty until you cap out at $50,000. So certainly the stick is really large and really kind of, I agree with you wholeheartedly. I think it's unnecessary. And I'm also a big believer that we can minimize the reporting to make sure everyone gets what they want. We can call it fair. But I think I agree that there could be just kind of one form that would go to both and that would satisfy the requirements and the needs for both. And that could also be easy for the individual to prepare on their own, not have to use a CPA, but prepare on their own and submit. I also think, and I was talking about this yesterday during a presentation, that the IRS, if you look at the way the tax return is laid out now, and I still always go back to, I was in DC when they were talking about the Tax Cuts and Jobs Act, and they were pitching it to tax practitioners. And some of the senators were telling me that, you could, Mish, you'll file your tax return on a postcard. And I'm looking at the 2025 1040, just page 1 and page 2, and it's like I almost have a seizure just looking at the changes they put in there, because it's just this gobbledygook. It's gotten so massive. But I wrote a blog post, I think it was back in 2019, about Schedule B Part 3 and how it's hidden down there. No one really looks at it. And how if you're going to use that to say someone's willful or non-willful, or say, hey, we alerted them to these requirements for both FBAR and 8938, that it should be more overt. It should be a standalone kind of form. Everyone should be required to read it. It should be in 17-point font, 20-point font for those. I now need readers. I can't see anything up close, but it should be really big and overt. You should have to look at it, read it, and say, okay, I got it, I understand. But it really is. It's not helpful, and it's not setting people up for success. And it feels like it's trapping people into pretty major issues that otherwise they shouldn't have to deal with. So. Anyway, I'll get off my soapbox.
Yeah. Well, and one additional point, when we're talking about individuals, is that FATCA also created an additional burden on what we call accidental Americans.
Yeah.
And so, it impacts expats, but expats are choosing to go abroad. They're very much, American, probably raised, used to American system. But what an accidental American is, I'll give you an example. Say the mother and father are here studying in the United States, and they receive their degrees, and then they head home. Well, while they were, becoming doctors here, or, scientists, or God forbid, lawyers, they have a child, and then they go back to their home country, and they're very proud of their home country. They only wanted to have that experience in the US to supplement their home country education. And their child never identifies as an American. He identifies as French or an Indian, or whatever country his parents are from, and he is a national of that. Well, what we have is birthright citizenship, whether and that's in the news, obviously, for a variety of reasons. But for accidental Americans, they never wanted birthright citizenship. They didn't apply to get a passport. Some of them have never returned to the US. They're adults. One who I know via LinkedIn well is Fabian Lahague, and he is the head of the Association of Accidental Americans. And this came to the fore during FATCA, because when these people have to fill out their self-certifications to open a bank account in, say, with Fabian in France, then he has to put his birthplace. And soon as it says USA and his parents were not diplomats, then the financial institution knows that he is a US person. And there have been many US persons around the world denied bank accounts, because if you're just in a small financial institution, here in the US, we think of our local savings and loans, institution as being just sort of that local bank. Well, think of that in the foreign country. You're their only US person. They do not want to take on the cost of FATCA, so they'd rather just say, no, I know it's convenient for you to have a bank account in your hometown, but we don't want to give that to you. And so that's what FATCA has done to people around the world. And there is a cost to renounce your citizenship. And in that process, it would then come out that, well, you never filed a tax return. You never filed, FBAR 8938, any kind of forms, because you didn't consider yourself American. And so that's another thing that I support those folks. I don't represent them, but it is something that has come out of FATCA.
Yeah, we represent a lot of them, and I think right now I've got 2 or 3 where accidental Americans, and they don't qualify for. There's a special IRS program called Relief Procedures for Former U.S. Citizens that you can use for people that don't have Social Security numbers, but the parameters are very strict. So they don't qualify for those. And so the biggest hiccup we have is that they have to go get their U.S. social so that we can then file the tax returns.
Mhm.
And then they're just going to give up their citizenship. And I'm like, this is just insane. It's like
Yeah.
the dog chasing the tail. Like it doesn't make a lot of sense. But moving on, let's go on to our next big topic here, because I think this is, I want to highlight this because we just worked together on a case, which I thought Elizabeth did a fantastic job. But tell me about what's going on with FATCA, with banks, hedge funds, asset managers, trust fund. Give me the inside baseball on that aspect, and that seems to be your bread and butter. Tell our audience about the gin, not the alcoholic beverage, and let's also just briefly talk about the general process for registering or with FATCA / staying in compliance with FATCA once you've registered.
Sure. I would say that, as we saw with our shared client, I think that internal communication is the number one thing for FATCA compliance. And I'm seeing it across a large number of jurisdictions around the world, frankly, is that you have turnover and you have no contingencies in place for that person's departure from your company. And so when you're stepping back to say, what do I have to do under FATCA? The first thing you have to do is determine what is your classification? What kind of company are you? Are you a manufacturing company? Are you a financial institution? And you think, well, that's just for financial institutions. But if you go to open an account and you have to complete a W-8 Ben-E, a W-8 IMY, these are U.S. IRS tax forms for non-U.S. entities. It could be that you are required to submit one of those. You're a non-U.S. company and you're submitting it to a non-U.S. jurisdiction because it's just easy for them to ask for that for their FATCA compliance. Or it could be on the financial institution self-certification. So even if you're manufacturing, you have to know which of the 32 categories of FATCA do you select. So switching over to just, you're in the financial industry, and of those 32, most of those classifications are all different aspects of the financial industry. And so you have to figure out, which one of those applies to this particular thing, this particular fund, or this particular service company for my financial institution. So you would either do that internally or externally with a service provider. Now, within your organization, let's just say an asset management company or private equity, you've got the folks who are doing really interesting deals or coming up with nice ideas for a new fund. And they execute everything from their knowledge base exceptionally well. But then they don't tell the FATCA CRS point people within the organization. So you're already behind because now you need to open a bank account and you don't know what the classification is. And if that classification turns out to be something that requires a GIN, Global Intermediary Identification Number, and you wanted that bank account opened yesterday, well, we need a little lead time to do the classification and then gather the information from you about that particular entity. It could be part of the acquisition structure over on private equity. It could be just the fund structure over on asset management. And we need to understand the structure to make the right classification. Then we say, okay, it needs a GIN. We then have to go into the IRS FATCA portal, enter this data, and hopefully the next day we'll get the GIN so that you can move forward on the bank account. Then moving forward, there are obligations related to that GIN. It depends on what jurisdiction your entity is in. And so we have intergovernmental agreements, IGAs is the acronym, because we all love acronyms. And so there are Model 1, Model 2 IGAs and non-IGA jurisdictions. And once you have that GIN, it could be you just have to worry about annual reporting either to the IRS or to the local jurisdiction, meaning, for example, directly to the Cayman Islands DITC portal or to the United Kingdom's HMRC portal. So it just depends on how that was implemented locally or reliant on the IRS. Reliant on the IRS would be non-IGA and Model 2. There you are sitting, outside the US, or your fund is sitting outside the US, but it's in, for example, Switzerland. Switzerland is a Model 2. And so that means you're doing that reporting, that FATCA reporting directly to the IRS. Switzerland is going to be changing, but for right now, you're using the IRS portal. You're also, because it's Model 2, so Model 2, non-IGA, those jurisdictions, most of our folks aren't going to be in non-IGA, like Liberia. So, but if they are, they have certifications that are due every 3 years. And so if you're not able to access that IRS portal, it seems so simple. What do you need a lawyer for? What do you need a high-level person for? You don't, as long as you have really good record keeping and communication internally. Because if people set up access to the portals, whether it's the IRS portal or the Cayman portal, using their specific work email, their identification information, then the organization can't get in there. And the IRS does not send messages that tell you the substance. They send you an email to say, go look at the message board. We sent you a message. So if you're locked out, you're not getting in to know what that message is. You don't know that you have certifications due. You don't know that your GIN has been revoked. And so these sound like just administrative tasks, which they are, but they can have, larger impacts, because if the GIN is no longer on the IRS, what we call FFI list, Foreign Financial Institution list, you have an account, for example, at Citibank, and Citibank can't validate your GIN because it's no longer on the IRS list. They know that you're a financial institution. They now put you into a certain category. It's called a non-participating financial institution. And Citibank might then have to withhold 30% across the board on FDAP income on that account. And so there's a lot of, major impacts from what appear to be small internal mistakes. And so the housekeeping is really important. And there are simple tricks, like having a bucket email instead of Mishkin's email or Elizabeth's email. Have a bucket email that people can access. And in the old days, as of a couple of years ago, or new days, you could just use a password to access the account. But the US government, for those who are unaware, is bit by bit trying to create a very large portal to make it more of a one-stop shopping opportunity for people who have to engage with the US government. And so as they're rolling that out across different aspects, you have a completely different method of accessing portals that might easily have been done regardless of the departure of your employee with a password. Now it's email specific. So that becomes very important. And then, continuing sort of down the path of tasks associated with FATCA. So you have your classification, potentially having to get a GIN, keeping up with responsibilities associated with the GIN. You have to do due diligence on your customers, your investors, your clients, whatever the vernacular is. And then you have to analyze the due diligence that you have done to determine whether there are any reportable persons. And reportable persons can be individual people, or they could be entities. And one thing that's unusual for lawyers is that we learned in school that we learned you can't pierce the corporate veil, that the corporation is a person. You can't look past it. You can and must in FATCA and Common Reporting Standard, that if there's a certain category, we call it a passive NFE, you have to look up, possibly through layers of entities, for what are called controlling persons. And so some of the concepts that we lawyers are used to don't apply when you talk about FATCA and CRS. And as far as the due diligence, we keep talking FATCA, there's huge overlap between the FATCA and CRS due diligence. One of the things that is significantly different with CRS is that CRS is this massive spider web. With FATCA, the US government wants to know US persons, citizen, green card, residency. CRS, they want to know all your tax residencies, because so if you have, for example, a Cayman fund, well, with FATCA, you're looking through your due diligence and you're saying, do we have any US persons? Okay, yep, there's 3 right there. No problem. We report those to the Cayman Authority. Cayman Authority sends that on to the IRS. After we hit our deadline, Cayman Authority hits their deadline. Done. Pretty simple.
Okay.
Once CRS came into the picture, Cayman Fund has to say, okay, there are over 100 jurisdictions participating in CRS. What are all the jurisdictions that of the people who are investors in our Cayman Fund? And we have to report on all of them to the Cayman Authority. The Cayman Authority in turn, and Cayman Authority, the Caymans, for those who don't know, it's not big on taxes. So it's not going to have a huge IRS, employee to draw on for this workload. So with the CRS, Cayman then has to sort through all of the data, for example, from this one fund or from Citibank, Cayman, to say, okay, here's 5 investors, that information goes to France. Here's 1 investor, that information, goes to Germany. Here's some more. They go over to Thailand. So they have to parse out and send to all of their counterparties around the world the information that that fund has given to the Cayman authorities. So FATCA, just U.S. persons, Common Reporting Standard, just every which way. And so when you're doing your due diligence, you're not just saying U.S. person, yes or no. You're saying list all of your tax residencies. And they'll also ask for a place of birth, because they also want to make sure they're capturing if you're not saying you're a U.S. person, but they can capture that, with the place of birth. And then there's other data that they have to collect, which is very much in line with another acronym, KYC, Know Your Customer. So the financial institutions already had to collect a lot of the data that they already collect, that they were then required to collect for FATCA CRS. So they already had the mindset for certain aspects of FATCA CRS. And then the reporting is annual, and it could be one year you don't have FATCA reporting, next year you do. And then each of the jurisdictions have implemented CRS into their local law. So there could be a little bit differences in CRS country to country. And then likewise with FATCA, you have certain requirements to the IRS, but then particularly if it's a Model 1 IGA, people say, I'm not going to be caught because, I'm in Mexico, and I'm, never going to the US. None of my clients are, but you're accountable to the Mexican authority because it's implemented in Mexico. And each of these jurisdictions can come up with penalties. And they could, as simple as say, like the British Virgin Islands started this a couple of years ago, out of the blue, started their compliance and said, email us your complete policies and procedures for FATCA and CRS. And so people are like, we're, one, not doing it, two, doing everything right, but we never wrote it down, and you're just caught. So there's different aspects, that you just have to be ready.
Wow, that's fascinating. And, I always tell people I learned so much on these podcasts. There's a lot about what you just broke down that I didn't even realize was kind of happening or going on. And certainly the topic that you brought up of the portals and kind of the shifting of the IRS to going that way, I'll just take a second to opine. I've been doing this I've been doing a lot of presentations recently, but I will once again opine to everyone that's listening to this call. If you're an individual person, you should go get an IRS online account, because that's where everything is kind of headed towards. Yeah, that's the way the IRS will be communicating, I think, moving forward. It's going to be less and less paper, certainly not phone calls or people showing up at your door, but more along the lines of something's in your IRS online account, go check it. And that's the notification kind of telling you if there's an issue with the IRS that you need to resolve. And by not having access to that account, you're doing yourself a disservice. Although I completely get the human mentality of it. It's kind of like going in for a doctor's checkup. Sometimes you just don't want to know. And I get that aspect of people as well too, but I strongly suggest that people consider that. And certainly with the FATCA, I think some of your suggestions on that are spot on as far as the way that you set it up, having kind of a catch-all email, that is not linked to a person in particular, but just kind of a catch-all, I think is a good idea as well. Moving on, because I want to make sure we hit everything here. Can you just briefly talk about CARF and kind of what your thoughts are on its current impact in the digital asset space?
Sure. And, I think that with CARF, people have to be very aware of their own jurisdiction, because there has been shifting. Initially, like we said, the OECD came up with the model for CARF, and there were like 40, 50 jurisdictions that said, yes, we will be the front runners. We will get our legislation in place, and we'll have a January 1, 2026 due diligence start date, with a goal of the reporting starting in 2027. And then you've seen people or jurisdictions such as the United States back away from that deadline. And so I would recommend that if people need to know, they should go to the OECD site. They have running lists of both Common Reporting Standard, CRS, as well as the Crypto Asset Reporting Framework, CARF, and they update those periodically. So it is something, if you have somebody in-house who's sort of checking on current events and news related to issues for your entities, you would want to have them check that, because your due diligence might have already started requirements.
Oh, really? Okay.
Depending upon jurisdiction. And so right now, there are jurisdictions around the world with the January 1, 2026 start date. And with Brazil, I think they even have some information that's reporting this summer. Brazil has a different sort of tax system, a more frequent reporting or filing system than some other jurisdictions. But for the most part, people are more on the annual cycle for things. And so if you do have the January 1, 2026 due diligence start, you would then have reporting requirements in spring of 2027. And so what you want to be doing, if you're not aware of this, is to start now in understanding the due diligence, because you might have to change your tracking systems, and most definitely your record keeping systems. And the difference between, FATCA and CRS, data collection on the onboarding as well as the reporting, it's different, but there's huge overlaps in the data you're collecting. And the idea behind it is, who are they? What country do we have to share the information with? And that key piece of information is the value. What is the asset value at the end of the year, or if the account was closed at that relevant point. But with CARF, it gets a little bit more specific because you're having to track specific asset categories and transactions. And the folks who are in the crypto asset world, they might view certain things in their mind as, not liquidating. I'm not, taking my crypto assets and converting into, TradFi currency. I'm just switching it from, Bitcoin to Ethereum,
Right.
but it is an event. And so, you have to think about what tax consequences for your individual tax returns. But if you are what is called a reporting crypto asset service provider, which runs the gamut, it can be in CRS, it's going to be an institution, an organization. It's a foreign financial institution. But with the reporting crypto asset service provider, that could be an individual, could be, somebody who, I happen to be an LLC. I don't need to be. I could just be Elizabeth McMorrow. I'm a lawyer providing services. I
Right.
choose to be an LLC. Similarly, I could provide crypto asset services just as myself, or I could have created an organization. Either way, what is being looked at is the services you provide, not whether it's done in the form of a company or as an individual. And so that's a difference between CRS and CARF. And so with CARF, you could have an entity service provider, a human being service provider, ATMs, crypto ATMs. All of these types of service providers have to have the due diligence in place. They have to be able to track the asset classes and the various types of transactions. Is it Bitcoin to outside of crypto world? Is it, from one crypto asset class to a different crypto asset class? These types of categories of information need to be tracked. And, I would say my personal view is, folks who are keen on crypto assets, they're very much libertarian, spirited people that they want to control their life, their funds, and they don't want to, and they want the rules so they know they're not violating the rules, but they don't want to have heavy-handed regulation. And so they might not be used to getting down in the weeds on the level of information that they need to start tracking. And so I would say, definitely check your jurisdiction to find out when it starts for you, and specifically the categories of information to track, and to realize also, even though you might not be comfortable holding on to people's, even though it's, you might just have the account numbers or however you're structured, you do need to hold on to the information for a certain number of years. And you want to check with your particular jurisdiction to know that, because record keeping is one of the important aspects of any of these compliance programs, FATCA, CRS, CARF, Bank Secrecy Act, all of these things that you could do everything correct. But if you can't show it, you could still end up being penalized.
Yeah, I always tell people, if someone asks for that, it doesn't matter if it's the IRS or some other jurisdiction, and you say, "Yep, I can go get it." Mentally, you've already lost your, you've already lost. Okay, I've seen this in FBAR audits all the time. It's like the auditor says, "Go give me the bank statements," and the client's like, "Yeah, I'll just go ask the bank for it." And I'm like, "No, you have a record keeping requirement under FinCEN, and if you tell them you have to go do that, you've already lost the argument. You're going to get your penalty. Like, there's going to be really no way out of that." So I think your comment there about their record keeping is spot on. I'll also add that I believe it was in December, the IRS released, I forget what part of the IRS did this, but they released a profile of folks that participate in digital assets and cryptocurrency. I think it was for the purposes of potentially offering a voluntary disclosure program for people that had not been reporting crypto correctly. But they did like a whole workup of like the profile, like you were saying, the libertarian, and they want to do it right. They want to know the rules, so they do it right. But they kind of have this interesting profile of how they operate. A very, very interesting space. And I certainly think we've got to get you back on the podcast to talk a little bit more about CARF and crypto related matters. And this thing really gets hot and heavy. Let's quickly go into your other practice areas, because I want people to know this other stuff that you do. I know that previously you were talking about the FBAR going to a different part of the Treasury, and you were mentioning that it's been around for a while. So I know what you're referring to there is the Bank Secrecy Act, which comes from our good friend Richard Nixon back in the 70s. Tell us about your other practice areas. I think you anti-bribery law, U.S. trade controls. Briefly, just kind of run through that real quick for our audience.
Sure. My primary, I have the background, Coca-Cola and biotech. And so, once in a while I'm helping out on completely non-financial industry things. But my bread and butter is the financial industry. And another aspect I help them with is the Bank Secrecy Act. And so that's making sure that your anti-money laundering and know your customer compliance are in place. And as part of that, you're also having to think about the Office of Foreign Asset Controls, or OFAC, another acronym. Mm-hmm. So when you hear about Russian sanctions or sanctions on Cuba or Iran, those are what we call usually OFAC, because there are other sanction regimes within the U.S. government, like with military and dual purpose items. But for the financial industry, it's usually about understanding through your KYC whether you have people from sanctioned areas, whether that's entities or individuals, what financial institutions you're dealing with. So if you're doing foreign wires, you should be checking to make sure that that financial institution is not on any kind of restricted list. And so I help clients with that across the financial industry. And then one that's more specific to the trust industry, I do independent examinations for trust companies in the US. There's a lot of Western state trust companies that their states have very useful legislative frameworks to help people who, particularly ultra high net worth people who want to set up trusts. I'm not a trust and estate lawyer. I help with the FATCA as well as the Bank Secrecy Act. Now, with the Bank Secrecy Act, as Mish said, you're dealing with a U.S. government body called FinCEN, and FinCEN is actually very small, has a very wide breadth of responsibilities, and they can engage in audits of, for example, a trust company. And the state regulator can engage in an audit of a trust company. And so that's where we help those trust companies.
Yeah, and if you've ever watched the movie The Accountant or The Accountant 2 with Ben Affleck, FinCEN is the government agency that I think is trying to come after him for all of his wheelings and dealings there. So you can see the logo kind of in the background for the government employees that are working there.
The infamous suspicious activity report is submitted to FinCEN. But I think one thing that's really important for people to realize is that all of the government, especially for folks who are not from the US, all of our US government agencies chat with each other. And if they feel that there's something that is going wrong by an organization or a person, but they can't put their finger on it, they might access information that has been submitted to the IRS or to FinCEN to help them further their investigation. So it's very important to look across all of your responsibilities and make sure that your reporting is consistent across responsibilities and that your reporting is being made.
Awesome. Okay, here's a fun question, and then I'll get to the very last one. If you were to have one of our BU law professors come on the podcast, I know my answer, and I'm not sure if you remember all the names of all the professors. I certainly don't. But if there was one favorite one that you'd want to come on and just kind of, get an update on where they're at, what they're doing, all that stuff, what would be? Do you have a certain professor in mind that you'd like to see come on the podcast? And that
I'm trying to remember his last name, and he was always a guest speaker. Like he would come in, Doug Stransky, maybe. I think he's with Sullivan and Worcester. And what I've always thought about Doug, I thought he was so enthusiastic about tax and just seemed to be an all-around nice guy. And I always thought, if I ever win the lottery, I'm going to Doug.
You know what you're doing, all right?
Doug, I think Doug can keep a secret, and I think Doug would be awesome in helping with all that planning. He just seemed to know the ins and outs of everything to do with taxation.
Okay. All right. That's a good answer. I like that one. I would pick Joe Darby. I loved his intellectual property class. He always had give you these wacky spreadsheets that had all the charts and all the different code sections. And I never ever thought about tax like that before in my life. So he definitely changed the ball game on that one. I was also a big fan of, I don't know if you took transfer pricing at all, but Ainsworth I thought was really nice. And I would definitely love to chat up with him. But okay, if someone wants to get a hold of you, how does that work? Like, how do you intake people? What's your general process for talking to someone about their issues? Like, how does your firm work like that?
Sure. So I have a website. It's Elizabeth McMorrow Law.com. And whether you want to, engage my services or not, if you're involved in any of the areas that we're talking about, I'm involved in, I would recommend you take a look at my blog, because I try to post regularly on that. Sometimes it's just news items that you might not see, particularly if you're not on the mailing list of the Big Four or somebody like that. I try to keep up with a lot. I'm also active on LinkedIn, and so you can find me there. My intake process just depends what part of the world. If you're in some far-flung place and you're panicked, I might even, help you out for free as a sorrowful American for having put the FATCA burden on you. But you can reach out to me. My email address is on my website. All my background is on the website. I do a lot of training for my clients. Not training where, sometimes people who are individual employees say, oh, can I sign up for your training? I do it for the organization and then the organization's employees. And so you can find all that information on my website. You can find me on LinkedIn, DM me on LinkedIn if you like as well.
Awesome. Yeah. And we'll go ahead and add links to everything for your website and your LinkedIn profile and all that stuff onto the show notes. So you can, if you're in Apple or Spotify and you're listening to the podcast or YouTube, it'll check out the show notes. You can probably find it there as well. It's just been such a pleasure. You're such a wealth of information. I knew from our first conversation when we reconnected, I was like, I got to get Elizabeth on the podcast, because I was just blown away by the level of knowledge that you have on this. And certainly, like I said earlier, I would love, if CARF goes more active, and we see some movement on that, would love to have you back. Or if there's something big that changes with FATCA or CRS, certainly we have, what we call frequent flyers on the podcast. And I would be honored if you would consider that potentially coming on in the future. But thank you so much for coming on. It was great having you.
Thanks a lot, Mishkin. Good seeing you.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.